Welcome everyone to the fourth webinar of our launch formula series. The objective of these sessions is to share some insight around the launch formula, which is our approach to commercializing innovation, and give you an understanding of the stages and steps you should be following when commercializing your innovation, your idea, or your product. It's our aim to give you the tools and insights needed to minimize any risk associated with bringing innovation to market. And we know statistically that more than 80% of innovations fail. And it's our intent to improve that success rate because it's way too low. I'd like to begin this session by acknowledging the traditional owners of the land in which we meet, and I pay my respects to elders past, present, and emerging. For those of you who joined us in the first few webinars, the first one, we highlighted the importance of understanding the market and the specific need of customers. We then went on to highlight the need for conceptual thinking and really understanding how your innovation will impact the market and potential customers. In the third session, we looked at the application of specific technologies in identifying your market, and Linda, who helped present that section, is here today as well. So thank you, Linda. All of these webinars are being recorded. And they're on our YouTube channel. So if you haven't done so already, please subscribe, and so you won't miss any past or future episodes. Well, hoping that you'll come to the live webinars anyway, but that's where we go. I'm your host, Marcus van Vugt, and today I'm really excited to introduce two excellent panelists as we investigate the value of the business case in framing both the go-to-market as well as using the business case when talking to potential early investors. Firstly, I'd like to introduce Steve Davis. Steve is an Advivo ICP innovation specialist and a general partner at Access Capital Ventures. Steve has a long history of innovation and has launched a number of his own startups and has assisted in bringing a number of products to the local and international market. He's also spent significant time with the federal government, Commercialisation Australia, and the accelerating commercialisation programs. So welcome, Steve.
Thanks, Marcus.
We're also joined by Dr. Chris Booth. Chris is co-owner of Amadin Group, based out of Brussels. He's an investment partner at 42 Ventures here in Australia, and also an advisor at Gallantry, which is in Australia, and End Strategy Consulting out of Malaysia. Chris is also a member of the Brisbane Angels and a startup supporter. Chris is passionate about driving innovative offerings to market, which includes market validation, securing investment, and executing corporate development. So welcome, Chris.
Thank you. Great to be here.
Thank you. We do have questions, some time at the end for questions. So if you do have any questions, please pop them in the chat, and we'll make sure we address them as we can. So I'd like to start the discussion by asking both Steve and Chris on what a business case means to them. And Steve, having brought a number of products to market and assessed many business cases from other companies, what elements of a business case do you believe are of greatest value?
Okay, well, to me, Marcus, a business case is really about the business strategy that you're going to follow to achieve success. So that's always going to be based on a number of assumptions. So the key thing to me is that I look for is how are those assumptions being validated? And to give you a couple of examples of what I mean, innovation needs to be solving a problem and addressing a particular job to be done. So in terms of the potential customers who might use that, who have you spoken to and what did they say in relation to how do they do the job now and whether they consider buying your solution under what terms? I don't know if anyone's familiar with the old On Prime series that CSIRO used to run. That was really aimed at researchers, where researchers were interested in doing research in commercially valid areas. So the first thing they did in that program, it's still the same principle, was they'd say, okay, well, who are your potential customers? And the goal you've got in the first couple of weeks is I want you to talk to 100 people that span across those potential customer segments and see what they say. And surprise, surprise, what you used to find year on year was probably 80 to 90% of the cohort would find their assumptions weren't valid, that there was something completely different, and they'd either realise that this wasn't an opportunity at all, or it might come out that they might pivot some direction that was a bit more valid. But unless you actually talk to people, you'd never really know. Your assumptions as you see them may well be wrong. So talking to customers and validating what your potential customers really think is quite key to me, to see what's in that plan. The second one is sort of an example about validation, is about the size of the market opportunity. And this comes down to understanding the market that you're trying to get into. I'll give you an example of something I remember from a previous case with some people I was talking to who had a concrete monitoring sensor for the construction industry. So I'll give you an example of what you do and don't want to see in terms of validating the market. And I'm sure this will resonate with you, Chris, as well. I mean, the first thing you don't want to see is an IBIS World figure that the construction industry in Australia is $400 billion a year. And if I could get 0.01% of that, I'll get a $40 million turnover every year, right? So you see that all the time, but that figure is completely meaningless because that's the construction industry. You're trying to sell concrete sensors, which is a very small subset of the industry. What does it really mean in terms of the number of concrete sensors we could sell? So what I look for is what I call a bottom-up analysis of that market opportunity. So who are we going to sell to? Well, those sensors are actually used in the large construction projects. Which companies are involved in doing that? How many of them are there? Sort of what sort of size projects do they do? How many of them they do a year? What does that equate to in terms of number of sensors, in terms of the concrete they use? So you might come up with a figure of 50,000 sensors a year might be the market, and at $100 a sensor, that's $5 million per year total addressable market. So at least that's a valid number that comes from assumptions that really mean something, and that $5 million number means a hell of a lot more than the $40 million finger in the air number we said at the beginning. So to me, as I said, the key thing I look for in a business case is validation, how they validated their assumptions.
Yeah, thanks, Steve. Chris, with your expertise in financing and particularly with angel investors, what are the elements that you look for in a business case?
Thanks, Marcus. I think for a broader context, where I am right now as a well, let's take a step back. I mean, I started as a shit-kicking analyst in the back room at UniQuest. 7 different faculty managers all coming with great ideas and great new innovations to be commercialized. And it was up to this guy to go and help find information that'll, as with Stephen was saying, validate the assumptions that are being made, build up the business case. And in those days, that was a matter of, okay, yes, you had the access to IBIS World and what have you. How do you cut it and slice it and dice it? And then university library, plenty of opportunities to try and dig for info there. But here it's very much, and certainly you could pay money to NERAC and get them to do a bespoke report when building up the final business case. In those instances, much further away from market, starting at the very raw innovation level. Having gone along the value chain in that context over time, building on that into venture capital, and indeed into angel groups, early stage informal and formal venture capital, if you will. What Steve was saying is absolutely right. I mean, we do, the TAM, the SAM, the SOM, yes, you could, if you just get 1% of the Chinese market, you're set, okay? Show us what's your go-to-market. How do you get there? And certainly that's where you're also saying, well, why that market? Is this one over here easier to get to? So overall, so back to the question. Overall, that's in the context of you're trying to work out, is this an investable proposition on an arm's length investment basis? You're not looking at it as an internal business case within a larger organization. You're looking at the team who's involved. You're also looking at the scope for the investment as well. What is the exit going to be? And in many cases, it's going to be as a trade sale. And so getting an understanding of who are the players within the segment or sector that this business is engaged in is absolutely invaluable. And if they get up there and pitch and say, we can do 1% of the Chinese market, and oh yeah, we'll do an IPO or a trade sale down the path, and say, right, thanks, no. Next, come back when you've got some proper insights.
Yeah.
Does that address the question?
I think it's also important to, we are specifically talking about attracting investors in this webinar, but the same principle apply to selling it to your own board or own internal staff. I mean, you've still got to come up with the right business decision and the right plan to follow even internally. So even if you're trying to raise it internally, so the principles that Chris and I are talking about are still valid even for an internal case. So.
I might extend on that, Steve, and just ask the question around, you know, if I'm running a program internally and I've got a business case, so traditionally corporates and boards look at costs rather than the revenue side first and foremost, right? And both of you have reflected on the market side, so the revenue side of what a business case might look like. What's your take on looking at the cost side of the business at the same time, really understanding where people are going with it?
Yeah, well, you've obviously got to. It's all about return on investment at the end of the day, for whether it's the investor or the company itself. So you've got to look at the pathway to get there in terms of the costs and things in investing to get to where you need to get to, versus the returns and what the timing of those returns are as well. It's cash flow comes into it as well, but also quantifying. The other thing I tend to look for as well is quantifying the value proposition. Yeah, unless you've got a reasonable benefit to cost ratio on the product, and it's never going to sell that well. So you do need to run the numbers as well. It's just that they need to be valid numbers, as we keep saying. They've got to be valid, based on some valid assumptions, not just plucked from the air kind of thing.
Right. So from what I'm hearing, it's validating the assumptions on cost as well, right? Because depending on capital investment needed to produce a particular product or whatever it might need, can drive the upfront cost, whereas your revenue will come down the track a lot later. And so therefore developing the trust and the understanding with investors as to how you're actually going to get there is key for that.
And that's sort of part of the strategy plan as well. I mean, the idea is to come up with a minimum viable product to begin with, so that you're not putting huge amounts of investment in before you get further validation as you go forward in the market. So that's all part of the strategy as well, and the cost flow that goes with it is what is that minimum viable product that's going to actually get you entrenched in the market to start with? What is that market entry strategy, and how much does all that cost as part of the equation?
Chris, you got anything to that side of the equation as a potential investor, looking at the cost structures that are applicable?
Yeah, look, I'll be quite honest that oftentimes the opportunities that we see coming through, they're operating in areas that are well characterized, that are well understood. And so we've got our own insights as to what the cost structures are going to be in most of those businesses. Certainly, we'd like to be abreast of developments in the space, and we do keep abreast of developments in the respective spaces. But yeah, I'd agree.
Okay, and Steve, you mentioned minimum viable products. In your experience, is there value as part of an early business case development to look at what does a minimum viable audience look like?
Yes, I think that's all part of knowing your market. You need to understand who those target customers are. Ideally you want to run an early adopter program to begin with. So you choose a few of those, you go and test feedback with them on that to make sure it does cut the mustard. They require blown into a whole singing, all dancing launch. So yes, I think that's all part of it. So.
And I'm going to, Leon's just posted a question that I might pose to both of you. Ultimately, any investor has to be revenue and cost verification, including reinvestment in growth and infrastructure. So understanding the dividend return, and Leon advises that it's often neglected in any pitch. Is that the case, Chris? Do you see that?
Well, I think
a long-term dividend return, or even a short-term.
Certainly not looking at dividend returns as a term in the finance sector. As a venture capital angel investment, we're very much looking at the equity growth of the business. So yes, the reinvestment of those profits back into the business. Obviously, that's getting to the point of just building the sales, building out the business, and making it a viable exit by a sale or IPO.
Steve, anything further? No.
No. So in terms of the sorts of business we're talking about here, about these very early stage businesses, yes, it's all about building value in the company in the early days before you can consider returns in terms of dividends and things. We're usually far earlier than that. So the sorts of companies that Chris and I have been more involved with are these early stage ones, which, as Chris said, more than likely will end up as a trade sale. So you've got to build as much value as you can into those through IP and traction with early customers to build that valuation.
Yeah. And Chris, in your experience, I know lots of people get very excited about their startup and the potential to float. And we know that 80% go through trade sales, if not more. How do you help people identify exit strategies? Because most of the time they're very focused on their product or service, and it's going to be the best thing since sliced bread. I'm not quite sure what came before sliced bread, but that's a different story. And how do you position a conversation with an innovator on that exit strategy and why they should have one?
No, it's a good question. I think that the underlying premise, though, is that we're not so much investing in the actual innovation, the product itself, but the overall proposition. Not just that there is a market need and here is the product or offering that goes to it, but this is the team that can take it forward. These are the finances that are required to address those markets in this manner with this outcome. And generally speaking, the people that are involved in the companies that we get involved with, the people leading these teams are very heavily involved and very knowledgeable in their verticals. But no, then that said, there are others that are entrepreneurs who haven't necessarily had a deep experience in a particular vertical that their innovation is addressing, and that's where, yeah, absolutely. I mean, market research, and just delving into what the opportunities are. And starting that outreach, engaging with those potential acquirers is always important.
Steve, what about your perspective?
Yeah, no, I think the team's always incredibly important, and more often than not, you'll find that the people needed to take to that next stage of growth are not the founders. They're just not the right people to do that. They more than often end up as CTOs because they're usually very well versed. It's usually their baby. They're the technical people that have usually come up with the idea in the first place. But so there's usually going to be an ongoing part of it is looking at whether those people are willing to hand the reins over at some point, or whether they're just, you can see that they're not coachable. I mean, the coachability is an important part that all investors look for in the team that's running it, as to how well they'll listen and that kind of stuff going forward. But exit strategy is something that we always do talk to them about, in the sense that, and again, that's part of knowing the market, because usually, more likely than not, it's going to be a strategic player that takes you out. So those guys are often your customers or people you're going to be selling to ultimately. So it's all part of knowing the market as well, as to who those people could potentially be to take you out.
How do you measure coachability of a founder?
It's whether they'll listen to me. So it's, no, you can tell. I mean, some people, will take things on board. You want them to have their own opinions, but they also need to at least take on board what other people are saying. But you do get very autocratic people that you can tell won't listen, and those people tend not to get invested in.
It sort of raises a separate question for me, which, Chris, the use of advisory boards at an early stage, is there value from an investor point of view? And how does that usually play out?
So what we generally see, certainly the rise of the organised advisor board is something that I'm seeing as being a very valuable proposition in the scale up sector, in that part where you've got a business that's shown initial traction, that's getting the extra money and need to scale out to something much bigger. When it comes to the earlier startup side, the innovators, I mean, certainly coming from a life sciences biotech background, the scientific advisory board is certainly a well-known quantity and has always been very important there. What I do see is certainly the value in a couple of key advisors being engaged or Yeah, indeed. I mean, coachability that we were talking about a second ago. Different people are coachable with different advisors or different mentors, and it is a more fluid thing in that respect of people meeting each other and actually clicking and working well at that very early stage as an advisor with the entrepreneur or the founder. So what we're seeing is that, many of the companies coming through have had that early advisor engagement that's been, and those are ones that are usually in a much better situation for raising capital and taking it forward.
So where's the value in accelerator programs? Because I know there's a large number of those around where, projects will be funded to a certain extent with a view of, you get some money and you're losing some equity type thing. What's your experience in those?
My experience is that there are accelerator programs and there are accelerator programs, and I don't know if Steve would be able to speak to this as well or not. And certainly my experience has been in the last decade has been more so overseas than back here in Australia. But in what I've seen recently, if you've got a good accelerator that's actually creating value, that has outcomes, that makes a business actually investable, for the investors, then brilliant. Accelerator is brilliant. What we're finding though is that most have been cynical. No, not most, but a lot have been cynical exercises of leveraging government grants for not much outcome, and sending companies to angel groups and VCs and saying, well, come on, here's one to invest in, and no, they're not investable. And then there's the odd argy-bargy toing and froing of, angel investors don't invest. Actually, yeah, we do, but in deals that are actually ready. Look, there's a handful of ones that are excellent, and certainly the Angel Loop and Gold Coast Innovation Hub paired together to create 42 ventures, or build up 42 ventures in its current iteration. And so using the accelerator program through GC Hub with Sharon Honeywell there, that's just brilliant. But you look more broadly, the Antler program and the kind of market validation that they seek from the entrepreneurs that are coming through there in that accelerator program is just incredibly valuable. So and StartMate and a few others we value very highly.
Well put, Chris. It's I completely agree. There are some very good ones, but there are a lot of just real estate plays as well. Basically,
with your former hat on, Steve, as an advisor in the accelerator program and the grants program, when you reflect on that, what are the points that you want to highlight to potential innovators and investors?
Well, what that was really, it wasn't an accelerator per se. It was just you just got assigned an advisor, which was us, that were managing the deal flow for the program. But we basically acted as advisors, literally as advisors for them. So we just helped them through all those early. And where an accelerator adds values in the very early stages, where they don't really know anything much at all, to help get their houses in order. And that's kind of what we helped do as well. We just part of, in fact, the whole application process was effectively putting together a business strategy, business case. That's what it got judged on. To get an accelerating commercialisation grant, it had to go through a committee, which was effectively like an investment committee, or it was an investment committee. Even though it was a grant, it was still treated as though it was an investment, and that's the way they judged them. So we had to sort of advise we advised them in the early stages of putting together an application. In fact, the whole application process was probably where they learned the most, because that's where we were full on interacting with them, giving them advice, telling them what was wrong with their business case, or no, that doesn't work. This doesn't stack up. Unless you can go and find me this, and this, I don't think this is going to go through. So they learned going through the process of what was really required, and more often than not, I'm sure Chris can relate to this, half the time they don't really know who their customer actually is until they go through this process, and all of a sudden they realise, it's not over there, it's over here where I should be actually targeting. So it's really pulling apart their whole business case, putting it back together, and that's largely what the good accelerators will help them do as well.
I know the Queensland government had, I think it was a $5,000 grant issued about 9 months ago, and within about 12 minutes, I think they had 3,000 applicants and had to close. which is more of a money grab than a real, can we actually develop something from scratch and take it forward?
Yeah, I mean, that's a totally different kettle of fish to something like accelerating commercialization. I mean, accelerated commercialization was incredibly difficult to get. So it certainly wasn't a money grab from that sense. You had to go through a lot of hoops to actually get to money. So,
and Chris, do you see money getting tighter in the current market?
Okay, so well, yes, I'd very much like to speak about that one, Marcus. But Steve, just getting back to it about the commercialisation grants. I've heard word more recently in the market that certainly, yes, there are very strong stamp of approval that this technology it's valuable and there is a market for the technology, but then some people have been questioning the value or the certainly you were talking there about building up the strategy and the business plan and what have you, but question marks sometimes get asked about the actual people that are running the businesses, taking it forward, and that coachability. I mean, obviously as an advisor you've got that you have that soft aspect to it of whether these people are worth investing into, but has that actually been taken into account in the past?
Yes, it does. I mean, very much so. In terms of quantitatively scoring those applications, then the biggest scoring section is management capability. So that comes into it as well. It's not just their past experience, it's also all those aspects of coachability, etc., that get looked at just the same way any other investor would look at it. So it certainly was. I mean, I've been out of it for a couple of years now, but it certainly was one of the most important sections that were looked at.
Okay, thank you. Well, Marcus, just getting back to your question, certainly, I mean, look, over the last 10 years, and if anyone wants to look up my LinkedIn profile and the posts I've been doing there, quite frankly, I mean, I was working in engaging with family offices and other private investors in Europe up until a couple of years ago when I came back late last year or early last year, and engaging more with private investors here in Australia as well. That with that cheap money being awash in the market, the general economy, investors were looking for yield. Now, when we're talking investors, we talk about family offices who've made money out of their areas. We're talking about private individuals, but then also in superannuation funds, other pension funds, institutional investors in that context. They were willing to take greater risk in such markets as innovation, in venture capital. And that's where you did see an inflow into the fund managers and also what we were seeing and what we're certainly seeing now in the last few months, I've seen half a dozen companies that are looking to either do a seed extension round or really think they're up to doing a Series A investment, attracting a Series A investment, where the previous round they received funding from outside investors, as they can be called, ones who don't know the dynamics of the power law of companies that are going to, you do the portfolio, and I don't know if everyone in the audience will know this. You do a portfolio of investments, high risk, potentially high reward, and you'll have one or two of them will more than outweigh with their returns are going to more than outweigh the losses on a whole lot of others that'll go bust, if you're to really reduce it. And so these outside investors who don't know that dynamic and don't price the round properly on that risk dynamic in that portfolio approach, they were paying at value. They were doing investments in looking for outcomes, in getting products to market, and getting these innovations along the company growth pathway. They were willing to go in at a much higher valuation than what professional investors or sophisticated, actual savvy early stage investors would. And so there are these half dozen companies now coming through that are used to having received the investment at a much higher valuation to what is actually risk adjusted, probable, necessary for doing a proper portfolio investment. So that has really changed the dynamic. In comparison, okay, when the first RBA interest rate hike was put out, the comment was made that there was the first time that 1 million Australian house owners had seen a rate rise. Now, on the founders, on the venture capital side of things, we're seeing a whole lot of entrepreneurs who've been given soft money, as I call it in that context, that are just having to take down rounds, but properly priced rounds, as we would argue. This is what it should be for us to see the necessary potential outcome after doing the market research on the acquirers to actually get involved in this round.
Now, Steve, on the back of that, and I think there's some really interesting comments there, Chris. On the back of those comments, is there value in enhancing a business case for an organisation to reflect the type of investors they should be looking for, and also on the counter of that, the ones they shouldn't deal with?
Well, it's always better to have an investor that come in that can add additional value if possible. So it's always good to have someone that's actually even a strategic investor that's likely to sort of add value and bring other value to the table. I've seen what Chris is talking about a couple of times as well with AC Ventures, where you've had a couple of very high net worths who don't really know the space and aren't so bothered about the valuation, and that does cause all sorts of problems, as he said. So we tend to walk away from those because the valuations just don't stack up for anybody else wanting to come in later on, and that just causes problems, sort of thing. So yeah.
What sort of problems do you see or arise toward the end when that happens?
Well, you just can't raise money at that sort of valuation. If it's been pushed up too high, then it just stops people coming in down the track. They just don't see the value. So you're seeing silly valuations based on what they're returning in recurring revenue or in assets, and it just doesn't stack up.
Yeah. Okay. And taking it back a few steps to the innovator, are there any tools or techniques, do you think, that they can pick up pretty quick that helps them articulate, validating assumptions, understanding market size, whatever the total addressable market or whatever it might be? Are there any tools and techniques they should be learning as part of this process whilst they go into it? Whether it's a business model canvas and how you actually use those.
Well, something like the business model canvas is really just a very high level sort of summary. It's not a bad way to sort of just get them focused on the things that you need to deal with, but it's kind of a 50,000 feet level type view. It's almost like the bones of what you're going to do, but then you've got to put all the meat on the bones to have an actual business case. So it's going down to those next levels of detail about how you get that. The question you're asking there is, how do you go about validating some of that sort of stuff? Well, look, there are other various business case templates around that are available from all sorts of organizations and accelerators and things, which will start to detail the sorts of things you need to find. But then to actually find them, you've got to go and do some decent market research. So you can go through other advisory organizations to help you do that kind of stuff. And as we've said in the previous webinar, Marcus, there's some pretty interesting data science tools now that can help you start to map and validate markets much more quickly than you could in the past. So all those sorts of things come into play to try and get ahead of the pack.
Cool. All right, what I might do is open it up to the audience and see if there's any questions. Either come off mute and raise the question, or alternatively just type it in the chat. But anything you've heard as a prize for the first question.
Not a question, just a comment. Guys, I agree with what's been said before. It's about the people a lot of the time that's driving the boat. It's the jockey or jockeys that win the race, not the horse they're on, and can have the best product and everything else like that. But if you got the wrong people driving the boat, it's not going to succeed. So the due diligence around the people, the lack of other complementary skills, what they've got or what the investors bring will have a huge impact on the long-term outcome and the ability to recover your investment and make a return.
Trevor's just raised a question. Chris, how much detail do you expect by way of validation within a business case?
Well, the best validation is paying customers, of course. Look, it's just got to, I say just, but you want to see information sourced from credible sources that are relevant, and getting down to actually addressing the specific niche or the specific offering of opportunity that is being addressed, not necessarily the big wide opportunity in a market. If that makes sense. That's pretty straightforward in that context.
I want to build on a question from Leon's comment around the jockeys that are on the horse. How deeply do you delve into the advisors that an innovator are using?
That's a good question. Look, honestly, in the local market, people know people. People get reputations, know reputations, good and bad. And you know, I mean, if it's clear that the outcome, so if the company coming through looks investable, it's not so much that the advisor is as important in that context. To date, going forward, yeah, sure, that might be more important, but more importantly, we're looking at what the strategy and is, and how that's been formulated, given what Steve was saying before about, you go and start validating something and actually no, that is the total wrong one. You go and pivot. Or was it you, Marcus? So it's, I mean, certainly if you've got a strong advisor with good reputation and good networks, that's very valuable. That definitely helps. Otherwise, it's applying rigor to a pretty straightforward process in that context without the extra value add of a good advisor.
I think the proof's in the pudding, Marcus. I mean, if the strategy stacks up and has the validation underneath it that all makes sense, then obviously the advisor's done a pretty good job anyway. If it'll stick out pretty well if it's not a good strategy, or in the end anyway. So the proof's in the pudding of what the strategy looks like and how well validated it actually is.
Thanks, Steve. Catherine, you've got a question for us.
Yes, I have. Thank you so much. Really interesting. I actually work on a global market accelerator program, so a lot of what you said is ringing true with the founders that we work in and scaling their businesses. One of the observations that I've made, and especially when they're probably at that growth stage, is the balance between managing cash flow, bringing on new talent, still building their customer revenue, scaling, and obviously understanding that the founder may have reached their boundary of capability. Have you got any sort of observations or good advice and guidance that you would speak to a founder when they kind of reach one of those crunch points and they're looking for investment to take them to the next scale? And the level of investment, when a lot of mine, they've gone from like 1 to 2 million, and they're now looking at the 5 to 8 to 10 million investment, so because they want to make that really next big leap.
Steve, would you like to jump on that one?
Well, it depends. I mean, that is the critical thing. Then is how, what are they going to use those funds for? I mean, it's you do want to scale, but they've got to make sure they put the things into the right areas, and usually that'll be a big push on sales and marketing. It does mean more staff, etc., or it might mean more infrastructure, all of those things. But they do need to understand the balance of how that money is going to be used, and some idea of what the returns are likely to be on that. There's no point putting it all into an infrastructure to be able to manufacture more stuff if you're not going to be able to have enough salespeople to sell it. So it depends on what the industry is and what that model is and what their business model is. But it's really making sure they understand how all those things scope out and which way you're going to allocate the funds to cause that growth, which is most likely to happen. And you do need to have that conversation with them as well. I mean, it's probably fairly evident by that stage whether they're the right person to take it to that next stage, the next 10, 12 million round. Do they have the skills to do that, or sometimes that comes out in the wash from the investors anyway? They'll make a decision on that and say, well, yeah, we're happy to invest, but we do need someone that's going to be able to take this to that next level. We're not happy that the current founder is in that position. He's certainly obviously going to be coming along for the ride and still important as a CTO, but is that person the right person to be the CEO? And that quite often that'll be driven by the investors more than anything, I think, towards the end of the day.
Thank you.
And indeed, if I could jump in on that one, Catherine, usually, you've got at least one investor representative on the board by that stage, and they are able to shape that discussion as both a governance advisor, but also as a confidant of the CEO founder in that context. And a good advisor from the outset would also be saying, you've got to be looking at the evolution of the skills needed as the business grows. You've got to be always asking, are you the right person to take this forward?
Yeah, sometimes it's quite an interesting conversation, especially when family has been the investor and they've having to out maybe another family member, or not out them, but move them on. That those can be really interesting conversations, and especially if they're putting that kind of money into the businesses. Yeah.
Yeah, I think there'd be many family companies that have gone through very challenging times, because in your case, Catherine, no doubt it becomes very personal rather than, from Chris's point of view, a portfolio perspective. So yeah, you get to play with people's emotions and approaches.
And certainly, Marcus, in that context, as a parallel, it's the sort of dynamic that you see in family offices oftentimes. And certainly, I've seen a number of times in Europe, and aware of it here in Australia, that perhaps the person who thinks that they're the anointed one isn't the right one.
It's true. Any other questions from the floor?
Just like to make a bit of a comment.
Mike.
In regard to the who do you back, the rider or the horse? That's actually been debunked a bit by data science work Thomas Thurston's done. Success factor, most strong success factor is luck, and the second one is probably timing into entry in the market, and the third is the people. That's my understanding. Is that right, Steve?
I was struggling to hear you there a bit, Mike, but I think yes, I agree. There's always an element of luck, but I think you could manage the strategic parts better these days with the tools that we've got at our disposal to try and work things out like that. But I think, yes, look, all of those things have to align, but the people, I think, whatever you do, I think the people are still a critical part of the equation.
Because they're not number one, as I recall. Anyway, we'll continue the argument later.
Yeah.
And look, I'm familiar with that discussion too. Indeed, I was discussing it with Linda Ginger on the call the other day, and that is the people by the data science aren't as influential in the outcomes as what you might think. However, what I would also suggest, though, is it depends on the data you're looking at. If that's taken globally, then obviously there's differing standards. Different standards, different cultures, different ethos of how a founder takes a business forward. And I would argue, and certainly we're seeing different levels of capability and mindset, different aspects with the founders coming through Angel Loop, Brisbane Angels, through Gold Coast Hub, 42 Ventures, elsewhere, and that's why we're just building that program, Angel Loop Innovators, to help elevate the founders themselves. And some are unteachable, some just are so dogmatic in how they want to go. Great, but this is also a great opportunity for them to develop their capabilities back around to, okay, is it the founders? Well, you're actually assuming that the founders are good enough to start with.
If you've got the right market entry strategy, it de-risks it in terms of the people that you're depending on. But I think by the same token, if you can still get people to screw it up if they're not the right people, even if you've got the right market entry strategy. So I think you still got to have both. You've still got to have you've definitely got to have the right market entry strategy. We're seeing that more and more from the data science, but off the back of that, you still need reasonable people to drive it, I think.
Yeah, you've got to assume that they've got a level of competency to start with.
Yep.
Thank you. Thanks for your question, Catherine. Comments? Now,
Thanks, Catherine.
I see Linda's typing something up, so I can't read it.
Short form or long form, Linda?
You can come off mute and tell us.
Yes.
No?
I was just going to say that I'll look forward to continuing having the argument about the research.
We can discuss over lunch. Yes, indeed.
No, but it is an interesting aspect that has got 15 years behind it, and it is global. And it's not specifically saying that the leadership is just the founder. That could be an element of it. But certainly the evidence shows that it really is about the market competitiveness in response to a new entrant to a market that is, causes the most damage as far as innovation failure is concerned. And you're right. We just need a good enough team that doesn't stuff it all up.
Doesn't stuff it up. Yeah. Yeah.
I think there's
you raise an
also
interesting point. Sorry.
I was just going to say it's interesting what Chris was just saying there. The execution of the strategic plan. A lot of people might have the strategy sort of worked out, but then the detailed execution plan and aligning that to the cash flows and everything else that it will impact on there is pretty important. And then monitoring that afterwards is ultimately where it can go wrong. So yeah, execution plan and the right people to execute, important.
Definitely. All right. Well, thank you, Steve, and thank you, Chris, for your insights today. Really appreciate, and I'm sure that everybody enjoyed the conversation and the thoughts that we need to take into account as innovators or as advisors and in different ways, or as investors. Our webinar number 5, we're going to hold at the end of November, 23rd of November. We're going to discuss a minimum viable product, and also how do we select and work with early adopters. So that's the intent of webinar 5. We'll be sending out invites and more details very shortly. And but with that, I'd like to thank you all for attending today. Really appreciate staying and with your insights and your thoughts and your opinions. So really much appreciated. And on behalf of Advivo ICP, thank you for attending.